opportunity for the other assets for those bond investors and the stock investors. So when the stock and the bonds are performing bad, so it is advisable for them to invest on the commodity futures, so they will get a better return. So the commodity futures and the return have a special effective in providing diversification opportunity. So they provide two explanations, the negative correlation between commodity futures and traditional asset class. Traditional asset class, they are calling stock and the bonds. First, commodity futures perform better in period of unexpected inflation. Second, commodity futures are diversification of cyclical variation on stock and the overall, from the evidence of this research, two conclusions are suggested. First, from the point of view of investors, historical performance of collateralized investment in commodity futures suggests that there are an attractive asset class for diversification traditional portfolio over traditional stock and the bonds. Second, the finding is challenging the well-known asset pricing model, asset pricing theory, which is more focusing on the equity, So it is better to include the issue of commodity under pricing model and so on. Finally, we raised some issue about Ethiopian stock market. We have Ethiopian Commodity Exchange Market, which is started since 2008, which makes it one of the newest global commodity exchange. So as of 2014, on average, 414 metric ton of commodity estimated on value of per 15 million transacted annually. So which is more of impacted the life of farmers. Maybe this is new information, I don't know. For Professor Dennis, Ethiopia is highly agricultural country. We have more than 18% farmers. So our country is providing exports. We export agricultural products. So this commodity market is a market for coffee. There are different varieties of coffee, sesame, and beans, maize, and wheat. So it's bringing highly impacting this commodity marketing, highly impacting the farmers. It makes farmers to empower them, to participate them, to enhance the quality of their products. This markets also give them market access. Even they help them to manage the risks. Even the market is helping them for planning when to produce, how to produce, when to come to the market. So we thank you all for your attention. We're sorry for the internet interruption. We will take comments and the questions.
So yeah, I have a question. So clearly there's a market in Ethiopia for these currency futures and so forth. So is it possible to do a study? I mean, is it similar to what we saw based on Ethiopian prices?
Yeah, pricing of those commodity stocks. Yeah, because now as you know that in the developed world there is better markets which is efficient sometimes also, that is semi-efficient, we may say that. We don't know whether this market is fully efficient, the price they are giving us, telling us fair price or not. Still it is an open place for studies, how the price is setting. Is the price is fair, how they are getting profits, normal profit or abnormal profit. I'm expecting that the investors are getting more than the farmers, despite the impacts the market is created. Still, it is an opportunity area for making studies, because starting from 2008 till now, the market is operating. We may have also some data. Still, there is data access problem is still there. Institutional transparency to give data is still there. But I think there is a researchable area, So if you, professor, you asked me, can you make study on this area? I'm thinking another issue. Lately, maybe let me invite Mulune or
I'm just,
Maskaram to say something about all
I
those
figure,
issues.
I'm sure this area has potential for study, and I'm just wondering how much study's been done and the type of studies and the different, because as you mentioned, there's so many angles to go with this in terms of efficiency, asset pricing, and so forth. Also in terms of different empirical studies. So I don't know if you guys are thinking along those lines.
Yeah. Can I come in?
Yeah, sure, please.
In fact, as you said, potentially the Ethiopian Commodity Exchange, the institution in itself, I think, is a very fertile ground to do studies of similar nature, if not exactly of the same type as the one we have reviewed now. I'm afraid the institution is currently operating in futures contracts. Rather, they are normally concentrating on spot transactions for immediate, delivery. One, it's not in the form of derivative. Rather, the spot transaction is for actual delivery. The platform is currently normally being used for, the exchange of the goods themselves, rather than the underlying derivative instrument, which is a futures contract. And besides, I have also some of my friends engaged in that floor, and I continuously hear that the market continuously suffers from inside trading. Buyers and sellers agree outside, and they just come into the floor to make use of that market as, just an instrument. Prices are set already outside, and they will exactly determine when they are going to deliver those goods into the ECX. They will inform this thing to their potential inside buyer. They will inform him. Then he will come and bid the required price.
That's interesting.
By the time he is informed by, the buyer, the seller. Yeah. So such type of insight. So, and more, it is also highly affected by seasonality of the product. As I told you, the very purpose of the market itself is mainly for delivery of the commodities, rather than to make use of the instruments as so the market will be active at the time where those goods are available, which normally is from October to December or so. In other periods, it's too inactive. It's too inactive. But generally, the modus operandi of the market itself can be a good input for researchers to look into, researchers like us.
Okay, now, only thing I mentioned, we have to see if we can get this last paper in. It'd be really interesting to see, we talked about all these correlations, it'd be interested to do some type of correlation to other markets, closely related markets and unrelated markets by distance, to see if there is arbitrage, per se, between Ethiopia to US, Ethiopia to Europe, and so forth. That would be also interesting to see if there's some type of financial arbitrage that could be exploited from just a pure investment standpoint. So that was the kind of the point that they try to make in the articles, that, as you mentioned, there's a very practical reason for these markets in terms of delivery of product, because you want to have stable prices. But now this also is an asset class followed by institutional investors that are able to use massive amounts of money to enter the market for arbitrage, excess profits, and so forth. So there's an investment angle. Insider trading is also an investment angle. So those are just thoughts. So, okay, very good job. I like that. That's very well done. Ms. Bugali, very well done. Ms. Meskura.
Okay, thank you, Ms.
Yeah.
Professor Daniels.
Okay, let's go and see Mr. Desalim. I think you have the floor. Let me stop sharing and you can take the, yeah, go right ahead.
Would you allow us to share the slide?
Yes, go right ahead, please. Yeah. Okay, I think it should be working now. There you go.
Is that visible now?
Yes.
Yes.
Okay. Thank you very much for giving me and my colleague the chance to present the paper entitled with an empirical investigation of corporate bond clawbacks or initial public offer clawbacks with the issue of debt renegotiation versus exercising the clawback option. This paper was published on Journal of Corporate Finance, and it was available on volume 20 from page 14 up to 21, and published in year 2013. And this is the DOI on which the paper is found, and we have actually accessed this paper from SSN RN. Actually, the account here created with the number of 21664 The authors of these papers are actually Kenneth and Daniels, Fernando Diaz Hurtado, Gabriel G. Ramrez, and me, Desalegn Mosisa, and Taye Tadesse are the presenters of this paper under the guidance of Professor Daniels. So this is the outline of the presentation. We will provide you some insight information related to theoretical background of this article, methodology of the article, finding, and at the end, we will provide our own suggestion and the critiques related to this paper. Some introductory concepts related to this paper. We know that corporate bond clawbacks or initial public offer clawbacks, sometimes what we call equity clawbacks, grew out of the high yield debt market of 1980s. And actually, we know that 1980s were the period when there is a farm recession since the World Great Depression. Actually, some Midwest farmers was already affected by such farm recessions, and there is high debt loads. Because of that, some investors took the option of corporate bond clawbacks. Therefore, the development of institutional investors with an appetite for high yield debt created original issue high yield debt markets, and actually they increase the usage of corporate bond clawback provisions. As per the previous authors, before the publication of this paper, with Daniels, Demis, and Jayaraman in the year 2019. The clawback provision in initial public offer clawbacks allows the debtor the option to redeem the present fraction of the bond within the present period at a predetermined price, as long as the fund or the money emanated from the equity offering. This is due to the reason that the investors use this clawback as a stepping stone to join the equity. Again, the author pointed out as initial public offering clawbacks have three features or three characteristics which are actually provided for this instrument. The first and the most important issue is actually the initial public offer clouds are predominantly high yield securities. They can provide high amount of return or yield as a security. Second, unlike other securities, they are rarely exercised. And finally, epochs have a relative short redemption window, which starts immediately from at the time of issuance up to the lifespan of 3 years. Therefore, the existence of those features or those characteristics come up with some important questions, like why the clawback options are exercised? Why the clawback options are exercised? Under what conditions the clawback options are exercised, and what impact it has on yields and debts renegotiations. Given the high yield offered on initial public offer clouds, it is not surprising that firms with relatively low leverage, higher return on equity, and that achieve the needed access to equity markets needs high amount of costs to exercise these initial public offer cloud options. Therefore, based on this backdrop of related to the features of initial public offer clouds, the questions which must be raised related to these issues and how they are exercised or renegotiated, we will support with empirical evidence as per the issue or the work performed by the authors, since they have gathered many empirical works related to the paper and how they have developed their hypothesis could be seen next to this issue. One thing that I wanna say about this paper is actually this paper is an extraordinary paper. The reason is the context or the issue of initial public offering, especially the issue of bond clawbacks, are new and they have emerged since 1980s. And even the first empirical work related to the bond clawbacks was performed by Gayal and his co-authors, 1998. And they come up with the finding that very small firms that are not very transparent to the public markets can use the corporate bond clawbacks. In addition to that, before performing this paper, Daniels and actually his co-authors on the paper published in the year 2009 come up that, or they conclude related to farm and initial public offers clouds, they assume instruments grant them to access the public debt markets, and this allows for the financial markets to improve transparency, because the previous authors or the breakthrough authors come up and conclude if the firm in the public markets are actually not transparent, because small firms unable to perform in such issues, they can seek for bond clawbacks. The same finding or the same issue come up with the findings of Daniels and his co-workers. Similarly, the Huang and Ramirez, the co-author of actually this paper, find that firms that are typically restricted from public markets use the 144A market as a stepping stone to reach public capital markets, as reflected that majority of 144A issues are subsequently registered as a public issues. We know that 144 is a regulation which is actually enforced by US SEC, Security and Exchange Commission, that sets the conditions under which some restricted, unregistered, and controlled securities can be sold or resold actually for that of the public, while 144A is when unregistered securities subsequently registered by exchanging some unregistered securities for the identical registered securities. Therefore, the intention of 144A and then 144 may be applicable in the initial public offering clause. Again, the Huang and the Ramirez, the authors, what we have seen in the previous slide, assumes that issuing in the 144A market is very expensive. Furthermore, the initial public offer have higher yields than other financing instruments as per the finding brought by Daniels and his supporters. Therefore, the authors expected that firms exercise the clawback option when they are able to achieve access to equity markets as a result of better transparencies. In addition to that, if they are performing, especially in the investment grade rating, though often they are, in case in 9044 or in actually 144 markets, would exhibit higher degree of transparency and better financial position. Those firms would need to show that they have strong fundamentals, possibly which is captured by the profitability measures. Firms who are not able to achieve the needed access to equity markets would find it in their best interest to renegotiate, which means because we have said it is very expensive to perform such issues. Therefore, some firms, if they are distressed, if they are very small, they can renegotiate. Even if they lack some amount of cash flow, especially inflow of cash, they can renegotiate some initial public offer clawbacks. In other words, authors argued that firms that use 144A markets and issue initial public offer clauses do not intend to carry clawbacked bonds to maturity. They are unable to carry these instruments till maturity because their main aim is to use these instruments as a stepping stone to join the equity markets. Therefore, they can do two things. The first one is either they can exercise the clawback provision or they can renegotiate the entire debt issue. The authors also provided some insights into factors affecting debt renegotiation and the disposition of creditors to debt renegotiation, as per found or concluded by Hennessy in year 2004. And actually, even they have demanded, or this previous research demand to perform additional research on the role of renegotiation in the debt contracts. Another empirical evidence, for example, Hart and Lemur, they have provided that if a firm lacks cash flow and their cash flow is not verifiable, they move to renegotiation, leaving exercising of this option. The reason is that actually some contracts may not be full, because designing the contract is actually very expensive, Again, debt renegotiation recognizes that debt contracts cannot bind all firm behavior. This is, as I have said, firm or businesses needs cost efficiency, because the main objective of the business is actually to enjoy with some amount of profits based on the market. Hence, creditors may anticipate possibility of renegotiation, which gives a degree of flexibility in the capital structure. Another empirical finding, which is performed by Christensen and his co-authors in year 2000, developed model in which equity holders determine renegotiating policy of the firm. Even they provide the issue of anticipate renegotiation policy and how they could be priced as per the coupon rates. As per their view, renegotiation possibility and exercise policy of clawback debt is a common knowledge of debt holders, because since those investors are holding the debt, they must know the background information about that issues and how it could be priced in the market. In the same vein, the authors assumes or believes that the clawback provision provides degree of flexibility in the capital structure for certain subset of firms which have the capability to take advantage of the options. In particular, firms which have access or expect to attain access to capital market and that are seeking to reduce their debt position in the short run may find the clawback provision relatively useful. This means they need the cash for a long run, but they may not consider it is long run impact or it is long run effect, so that they can assume this issue for a short-term period of time and they can actually use renegotiation. Compared to convertible bonds, the initial public offer clawbacks are best suited because convertible bond has significant protection period, or they have actually protection period. And even the initial public offer allows firm the ability to alter their capital structure. They can change their own capital structure of equity and that of the debt. Therefore, the Wang and Noy illustrates debt restructuring is strategic, and even it is fundamentally a stronger firm that seek to avoid renegotiation. That means they can exercise the cloud or bond cloud because it can have several impacts on their long-term existence. Therefore, based on those empirical evidences, the authors have developed some hypotheses so that they can prove with their own methodology and their data. The first hypothesis is firm financial characteristics influence the probability of the clawback option to be exercised versus renegotiation of actually the initial public offer cloud issues. This means the issue of actually two things. The first one is the good accounting fundamentals are associated with exercised clawback bonds. And the second one is firms with low leverage more likely exercise the clawback provisions, and non-investing grade firms are more likely renegotiate their debts. So the main ideas from which this hypothesis developed or pointed out is not initial public offer clauses are either exercised or renegotiated. Some of them may be exercised, some of them may be renegotiated, and actually they may be held till maturity or they may be renegotiated. Even the authors pointed out that it is general interest to know what financial features are associated with those types of firm. Actually, though it is not the main focus of this paper. The authors also argued that if firm plans to carry an epoch to maturity, those would more likely to be observed for firms going directly to the public market. Even Daniels and his co-authors in their article published in year 2009 also pointed out that the clawback provision is expensive when they have already compared with callable and the straight debt. We know that the straight debt means the holders hold until maturity or actually sell it to another investors. Another most important issue that the author have raised and makes it their evidence to come up with that hypothesis is actually information asymmetry. They have pointed out two things. The first one is a small farm have asymmetric information. The same when if those farms have poor rating, especially credit rating, they have still information asymmetry. It's information asymmetry because they have no capacity to assess, they have no capacity to make the research and come up with some new ideas related to the information. Body, Taggart, and actually Thatcher, Krabi, and Helwage, respectively, deal with the issue of mitigating information asymmetry problems. Therefore, the clawback provision may be more attractive to certain firms, particularly if a firm has better likelihood of issuing equity in the near term, because we have said the bond clawbacks could be performed if the firm come up with the funds from the equity. Call provisions generally have long detriment period. Actually, detriment period, when we say it is straight meaning with deferred period, the time period, the issue of security, during which it cannot be controlled by it cannot be called by that of the issuer of the security or issuer of the bond. Therefore, the average term for clawback exercise provision is generally shorter. That means as the groundbreaking author related to bond clawback assumes Gayal and his supporter or his co-authors, it takes from issuing period up to 3 years. And the small firms and the firms with lower credit rating may prefer to use the 144A markets and are not likely to be able to use the clawback provisions because, as we have said, they lack some transparency and they lack some financial position. In any case, accessing debt market with clawback debts may not be costless for those firms. That is why they can march to some traditional way of dealing with their own financial instruments. Bondholders recognize the benefit to issuers and shareholders from those clawback provisions and price such debts accordingly. Finally, the authors come up with hypothesis 2 of clawback bonds, which are exercised should have higher offering yields than clawback bonds, which are not exercised, based on the information that bondholders face substantial reinvestment risks. Because if the clawback provision is exercised, and the market should price this risk accordingly. And even the debts with clawback features, which is actually expected to be more costly than that of straight debts, as we have said earlier, the clawback bond that are more likely to be exercised ex ante should experience higher yields relative to that of clawback bonds, because we know that the firm who can exercise the clawback bonds have higher return on equity, and even they have lower leverage, while the bonds or while the investors who are not exercising those issues or those clawback bonds have lower return on equity and that of higher leverage. That is why the authors come up with the hypothesis of clawback bonds which are exercised should have higher offering yields than clawback bonds which are not exercised. Thank you very much. And the next issue may be presented by my colleague, Mr. Taye. Are you hearing me?
Taye.
Not here.
He might left the meeting.
Sorry. He assumes I got power interruption.
Okay.
Yeah.
Okay, we'll stop there. We're coming up on 10 o'clock anyway, so we'll let him finish on Thursday. He can start us off on Thursday. Could you let him know that he'll start us off on Thursday? Mr. Deslam, can you let Taye know that he'll start us off on Thursday?
Yes, Professor.
Okay, so I asked a question.
Thursday?
So that's the questions for you.
Yeah, continue.
So the point of the callback is, the leverage ratio, debt negotiation, and the capital structure. So what is your view on this from an investment standpoint, from investing for equity? Because the whole point of the clawback is that if a clawback on the exercise of the clawback, they will issue this new equity and essentially pay down the debt. But the firm already has equity, so, you know, what do you feel about the impact of dilution? Mr. Taye, you here?
Mr. Taye have joined, yeah?
Would you like to
Shall
go ahead
we
and continue,
continue and-
Taye? So think about that question, Ms. Taye, if you want to continue, go ahead.
Yes, I'm just now joined. May I continue, please?
Yeah, go ahead and screen share. Go right ahead, yeah.
Okay, thank you.
Make sure I can get that aside.
You see it?
Yeah, yeah.
Yep, go ahead.
Okay, thank you. And sorry for the power interruption, please.
Mhm.
Okay. Thank you for giving me this chance to present on the issue of the empirical investigation of corporate bond clawbacks, focusing on the debt renegotiations and just exercising the clawback options. And just we give great credit to the Professor Daniel and his co-researchers for having this novel idea. And having the information just with my friend Desalegn presented. And let me start from the methodology. The first issue is regarding the data selection and sample construction issues. Authors first selected the sample of corporate bonds with the clawback provisions. They obtained all the corporate bonds from the fixed income security database that have flag for clawbacks during just the period of 1993 to 2008, around for 15 years. They made one thing, the just a cleaning of the resulting observation, eliminated some repeating observations, and they able to just match with the Bloomberg database, and they got the sample of the initial public offering clawbacks reduced to 1,674 bonds that exercise clawbacks or just renegotiate it. Now, for further analysis, they used the econometric model, that's the probit model and the OLS, in order to answer the issue of either exercising or renegotiating, or just and to identify the impact of the exercising on the yields. And they identified this by the OLS model, and we'll see it. As you observe from their data selection, they have selected, and just there are about 2 panels regarding the data selections. The first one is just the distribution of the initial public offering clawbacks, either exercised or negotiated, that distributed yearly. As you observe that from 1993 to 2008, the renegotiated samples and exercised samples are given here, as you observe. In 1993, for renegotiation, you observe that about 42 samples and 6 exercised. And the last one, 2008, you observe about 6 renegotiations and 0 exercising. As you observe, for the renegotiations, it just gets to peak around 2000 to 2000, of course, sorry, 1997 and 1998, as you observe, 1999. For again 2002, 2003, and 4 are again for the time peak for it. For the exercise, it gets peak to 2000, 2003, and 2004, as you observe that. From the total, if you see the total sample exercised, the clawbacks, it's only just 204 samples exercised, and the remaining 1,470 were renegotiated. From these 204 samples accounts to about 12 point something just percent from the total samples. Panel B indicates that the distribution of samples against the industry you see that like automobiles from the sector of economics, chemicals, clothing, the transportations, utilities, retail companies selected. Then from this, the renegotiated industries and exercised industries, as you observe. For automobiles, just about 29 samples renegotiated, and just about 8 samples were exercised. And the utilities, about 24 samples, and the exercised one just shows about 11 samples. Totally, just here again, 204 samples were exercised, and the remaining 1,470 were renegotiated. Based on this, just the lifespan of the from 3-year period between 1997 and 1999 represents the highest rates for clawback exercised, as I told you, and just around 2002 and 2005 shows the peak time for the exercise. As panel B shows that the financial sector, the retail sector, and the oil machinery shows about most experienced with high number of exercising, and it accounts for utilities about 31%, just which is 11 samples are exercised in this case. Based on this, the time period for this study shows 1993 to 2008 for the global features, and only just about 12.19 accounts to the exercising, which shows about 204 from the total sample of 1,674 as we observe from the samples. Okay, the descriptive statistics from table 2, we observe that the bond sample and the contrast characteristics, the mean and the standard deviations were given in this case, and it indicates that the corporate actions are like that of non-exercising the clawbacks, exercising the clawbacks as an alternative, no renegotiations, and the renegotiation just indicated in this table. Now we observe one thing from this table at the date of what's the difference of the action, corporate actions at the date of issuance and just on the date of exercise, as you observe that. Now for the renegotiation and exercising actions, the offering yield shows indicators about 9.98 mean, and in the bracket we observe that the standard deviation for exercising it's about 10.47 mean for offering yield. For leverage it's 0.55 and 0.53 for negotiation and exercising respectively. For just log of maturity, we observe about 2.14 mean and 2.10 just mean for renegotiation and exercising respectively again. On the date of exercising, the initial public offering clawbacks rate just indicates for leverage, for log of assets, return on equities, as we observe. For leverage, it's about 0.57 and 0.50 for renegotiation and exercising respectively. For log of assets, 7.31 and 7.59, that indicates some just slight difference from at the date of issuance. Now, the authors, my professor Daniels and just his co-researchers evaluated the issuer at the issue date and at the exercise date of clawback to determine the change in fundamentals between the two dates, that's the issuance date and the exercising date. As we observe, on the at the issuance date, the bonds with exercise clawback indicated by the issue size and asset size, and just it's indicates the leverage between the firms that renegotiates and the firms that exercise the clawback are not significantly different at the issue date. As you observe from the sample, there was no great difference just in terms of size. Again, the clawback bonds have higher offering yield and a shorter maturity at the issuance dates for maturity. The higher offering yield, there is a difference and a shorter maturity at the issuance date. At the expiration date, bonds with exercised clawback have, as my friend discussed before, the lower leverage. They are just characterized with still relatively larger by size of asset, less likely to have non-investment grade or just investment grade. When it comes to the empirical analysis for analyzing data using the econometric model, authors provided an empirical investigation of whether the firm, issue, or just market characteristics are determinants of the decision to just exercise or renegotiate the clawback. In their sample, the authors indicated the issuers either exercise the clawback bond or renegotiate the clawback bond. One thing that you have to understand is that the word clawback is just to mean that to get back. They investigated the propensity to exercise the clawback in the following manner. The first point is that in order to indicate whether the probability of exercising the clawback bond or just renegotiating. In this case, we observe that the probability of exercising is just formulated in this bond. Clawback bond is a function of the credit quality, the issue and the issuer characteristics, the market access. And the model is here just developed by our professor and his co-researchers. The probability to exercise the clawback is given as a density function of beta naught, beta 1 times log of assets, beta 2 times return on equity, beta 3 just times leverage, beta 4 times log of size, beta 5 with log of maturity, the credit rating multiplied with the beta of the Standard and Poor, the beta 7 144 just A with demi variables and the disturbance term. As you observe, the authors used the proxy for credit quality as an ordinal variable for the Standard and Poor credit ratings. And they give that one represents, since it is demi, it represents just, ordinal variable represents AAA, triple A, and just 2 represents capital A and just double small a, and just so forth. Bonds with different credit ratings may have different market access. The lower credit rating may not have market access as the higher credit rating. The author's expectation when they are doing their research is that the credit quality may have an impact on the ability of the firm to exercise the clawback provision. That means firms with better credit quality are more likely to exercise the option. We'll see this expectation result later on, just on the model. Their issuer characteristics is just the issuer characteristics indicates a vector of variables capturing the nature and the type of the issuers, which includes the log of total assets, the leverage, and the return on equity. Again, the issue characteristics, the issuer characteristics and the issue characteristics are just given different variables. This issue characteristics indicates the vector variables capturing of the contract terms of each, which includes log of the maturity and the log of the size in this case. Again, the researchers use demi variable D1 for A to capture the firm's accessibility to the public market in this case. And they argued that firms with stronger accounting fundamentals are more likely to exercise the clawback provisions, as it is again discussed in detail in the empirical evidence by Mr. Desalegn. This implies that firms which choose to renegotiate have higher leverage, lower just return on equity, and are more likely to non-investment grade, which is opposite to the probability of just exercising. Authors estimated the relationship between credit issue and issuer characteristics and offering yields using the ordinary least square regressions. We have this model for in order to indicate the impact of the exercise, the probability of exercising the clawbacks on the yield. Then they identified that offering yields is a function of exercised, as we discussed before, the credit quality, the issue, and the issuer characteristics in this case. The main variable of interest is, of course, it is just the variable exercising. Having this, we need to identify that whether it has a positive or negative impact on offering yields. Based on this, authors used multivariate analysis in order to estimate the impact of and the relationship of the variable exercising on the offering yields. And the yield is given as beta naught, beta 1 times exercise, the leverage, the standard and the poor credit rating, log of just the asset, return on equity, and the log of maturity with a log of size. The yield in this case, an initial offering, as reported in the fixed income just security database, the authors controlled the firm just the control for time trends and industries using the vector of Demis given as GI. They also controlled for industry concentration using the ordinary least square estimation, accounting for clustering the industry. And this variable is just not in time of the bond issuance that is used to capture the investor's expectation that the firm will exercise the bond clawbacks. Now, the corporate actions like that of exercising the clawback are or renegotiating are the important strategic events and have consequence on the firm value in general. Corporate actions are anticipated by the market, and the effect of the corporate action is stronger in this case when creditors are particularly vulnerable to the strategic threats, including risky firms with high managerial shareholdings, simple debt structures, and high liquidation costs. From their model predictions and implications, our professor and his just co-researchers' expectation was the positive relationship between exercise and the yield, the size of the issue to be negatively related to the yield, and the negative relationship between the size of the firm, return on equity, maturity with that of the yield, and the positive relationship between the yield and the leverage, as well as the standard and the poor rating. Again, this is evidenced with the work of Professor Daniel in published in 2009. When it comes to the likelihood of an exercise bond clawback, yes, in order to check for our just the researchers' expectation and as a hypothesis, they used about 4 models in this case, and this presented in table 3 in this case, and this table indicates the results exercised clawback. The probit regression having different models. Model 1 estimated without year and industry fixed. The model 2 estimated with year but not with industry fixed. Model 3 without year but with industry fixed. Model 4 indicates the estimation with both year and industry fixed and indicated in this table. The estimation of probit model for the probability of exercising the clawback option using 1,193 corporate bonds during the year from 1993 to 2008. The dependent variable in this case, as we discussed before, is exercised. We are talking about the likelihood of the exercising. It is given 1, if the initial public offering clawbacks is exercised, otherwise zero. If it is just a renegotiations. The initial public offering clawbacks that are not renegotiated or exercised are not part of this regression. It's not part of just because it's just excluded. The independent variables in this case are, as we discussed in the model, the log of size, the log of asset, return on equity, leverage, which is measured by the total debt to just the total assets, log of size, the natural log of the issue amount, log of maturity that's given as a just demi variable, the standard report that takes the value of 1 if the firms have non-investment grade, otherwise 0. And the demi variable 144A that takes the value of 1 if the firm uses 144 capital A market to issue the dates, otherwise. Just again, the significance level of these variables indicated in just parentheses, and the table indicates about this result. The regression result for exercising the variable, the log of asset, return on equity here in the just under 4 models as we discussed before. Log of assets in the first model, just its coefficient shows negative relationship with exercise, exercising the clawbacks. It's the same thing for the remaining models again. Return on equity, positive relationship, and it is just significant as you observe in the bracket. Almost it is 0. It is 0. The leverage, negative relationship in 4 models, and it is just significant for the first 3 models. Log of maturity, negative relationship with the exercising, and just as you observe that for the first 3 models, it is just significant. For the standard and the poor, negative relationship, and it is insignificant as you observe that. Having this, the authors found that the probability of a clawback being exercised is positive related with the return on equity, and the negative related, as we observed from the table, to leverage, and it's statistically significant. What is the implication of these variables related to the exercise? It implies that the firms that are more fundamentally sound in terms of the profitability and the solvency are more likely to exercise the clawback. If they are fundamentally sound and more profitable, yes, they have the higher possibility to just exercise the clawback. Otherwise, just renegotiation is another alternative. To exercise, the market must just perceive that these firms are transparent and strong enough to be issue the equity. This is the other implication related to the probability of exercise. Having strong fundamentals help firms to establish themselves in equity capital markets. And the examination of the issue characteristics as other variables related to the exercise, the size of the issue, the log of the size, has significantly positive relationship with propensity to exercise the clawbacks of the bond. The positive significant coefficient suggests greater transparency because larger issue involve more scrutiny, just under the underwriting process in this case. Okay, their arguments, the argument of the authors in this case indicators the initial public offering clawbacks always just firms are seeking access to equity markets, but not candidates to issue just in the public markets. And this indicates that they go through 144 as an alternative market when seeking external funding other than the formal financial institutions or just bank loan. The significant negative coefficient for 144A demi indicators if firm uses 144 market to raise the original funds, it would be more likely to just not to exercise the clawback option. And the alternative is just the difficulty to establish themselves to move up in the public equity markets and unable to issue the needed equity to exercise the clawback, because there should be strong issuance of equity to just exercise these clawback bonds in general. Given the high costs of the initial public offering clawbacks, as my friend discussed before, and the likely financial distress, the firms end up renegotiating rather than exercising it. The results are consistent with the hypothesis my friend just told to us, and the priori just believes that relatively good accounting fundamentals are associated with exercising in this case. Authors' results in relation to the log of maturity indicates maturity has a significant negative relationship with the exercise, as we just observed from the table, the regression table. It suggests the clawback bonds with longer maturity in general, longer maturity, and this one is consistent with the previous authors. Longer maturity contracts are more likely to be just renegotiated in general rather than exercising. It doesn't allow just in order to exercise we need a short maturity. In this case, they found that 144A issues are also more likely to be just renegotiated, as indicated by the significant negative relationship with the propensity to exercise. The firm size as another variable, just measured by log of assets, does not have a significant effect on the probabilities of exercising the bond issue. The firm size again also does not just impact the decision to renegotiate the clawbacks, and has just this one again the major implication. The other objective of the researcher of this article is to identify the impact of exercising on the bond clawbacks in initial public offering yields. The estimation also just done as in the case of the model with the probability of exercising for models, the same thing just done in this case. And for the table present the estimation of OLS model in order to indicate the relationship between the issue and the firm characteristics in clawback option, which is eventually exercised. The dependent variable in this model indicates the yield of initial public offering clawbacks. The independent or the explanatory variable used in this case by the researcher indicates log of assets, return on equity, the leverage, the log of size, the maturity, log of maturity, the standard and poor, and just 144A as the measurement, just as I told you before. This table indicates the impact of exercise and other variables, even if exercise is given just due attention in this case. Others are also presented in this table to indicate their relationship and impact on the yield. The exercise, as you observe that, it has positive relationship in all models with the yield. And as you observe that, it is significantly affected. It has a positive relationship, significant impact on the yield. The leverage, yes, positive relationship. The coefficients are positive as you observe from the table, and yes, it indicates significant impact on the yield. The standard and the poor, again, positive and significant impact. The log of assets indicates negative relationship, and just except the second model, it indicates that significant impact. The log of maturity for two models, negative relationship. For two models, just positive relationship. Having this in mind, even if the focus of the attention is just the exercise variable, now, which is expected to capture the possible impact of exercising on clawback provision yield, yields, its coefficient just ranges between 1.6 to 70.3 just basis points, and the level of significance at 1%, as you observe it. These results indicate bond market recognize the risk of early redemption, the probability of exercising clawback, and pricing, yes, the risk accordingly. This is consistent with the second hypothesis that indicates the relationship between the exercise and the offering. Then the examination of the individual coefficients show most variables have X factors sign as per the expectation of the researchers, and their coefficient, the same thing. Leverage and the demi-variable of the credit quality has a positive and a negative, a significant relationship with its coefficients. Log of asset has significant negative relationship. The coefficient of return on equity is just, of course, it's not statistically different from there. And the maturity has a negative and significant coefficients in two of the four models as we observed from this. When it comes to the concluding just remarks, consistent with hypothesis one, indicating firms with low leverage are likely to exercise the global provision of the bond with, while the non-investment is more likely to just renegotiate their debt. Consisting with hypothesis two, the firms have very low probability of exercising the global provision should also have lower yields, and that the yields on initial public offering clawbacks are just associated as expected with the firm, the issue, and the market risk. Based on this, authors documented that they have identified and evidenced the clawback bonds are often renegotiated, and the clawback provisions are rarely exercised, as it is just evidenced what the empirical evidence. They found that probability of exercising the clawback option increases if the firm has one, lower leverage, the other better return on equity or higher return on equity, the other not issuing in the 144 market. The second finding of the researcher shows the higher the yields observed on clawback bonds are associated with the likelihood of the clawback provision being exercised. Again, they argued that the results are consistent with the view that firms use global provisions are likely to have better fundamentals in accounting, improved just fundamental. The third finding indicates firms exercise the global provision because the firms are able to access equity markets and issue the needed equity or the number of equity that the market needs in order to exercise this global option. The first one, renegotiation global bond results from the need to just refinance the high cost of initial public offering clawbacks issues and the difficulty in accessing the equity capital market. The fifth point, firms that exercise the clawback provision tend to have, as we discussed before, lower leverage over time between the issue date and the clawback expiration date, as we observed just from the descriptive statistics. Firms that renegotiate their debts tend to have higher leverage ratio over time between the issuance dates and the clawback expiration date. Yields on initial public offering clawbacks issues are positively associated with the probability of the clawback options being exercised. Having these, let's put as a just reverse our views on the article. We do have some points to review, like the title of the article, the abstract, the background of the article, the problem statement issues, research questions are our points of reference in order to just give our points on this. Now, if we see the article of the title of this article, we got it. It is precise, clear, and it is very just informative title, and it's a novel idea that I have never seen in the articles I read till now, because just this one is new for Ethiopia. Again, it is informative about the objective of the research. What it indicates what the objective the researchers wanted to do. The dependent and dependent variables are clearly indicated in this article. The abstract, properly constructed in this case. The finding of the studies, the general concept related to the topic are well documented as we observe. The background of the study, it is properly and just adequately documented as my friend just presented before. The problem of statements, it's clearly stated and it's very directional where it indicates the destination where the researcher wants to arrive. The research question, even if there is no separate section, we have identified 3 major research questions, which indicates why, what, and under what conditions the exercising and the renegotiation takes place. The objective, it is clear and achievable objective, as we have observed from the expectations that the researchers put. The literature issue, it is very adequate, theoretically and empirically. It's very just substantiated with adequate empirical literatures. We could integrate one thing from this article is just we could integrate the conceptual framework. That's one of our observation. The methodology, the data sources were properly identified just from the fixed income data, fixed income security databases from Bloomberg are the data sources. The research approach, research design were not, of course, clearly separately indicated, of course, but it is just by default we know what is the research approach in this case. The analysis properly addressed the objective of the study and empirically substantiated with the previous researchers. The conclusions, it is well concluded as our observations regarding the evidence, the reference, the in-text citations, and the reference lists were properly done. For that, we give great credit to our professor and his co-researchers. Okay, thank you for your time and attention, and just welcome for some the comments that you have and the question. Thank you very much.
Okay, thank you very much. We've overextended our time for the day, so we'll be brief, but very nice job. Appreciate that. Tell your classmates on Thursday that we want to be able to talk a little bit about your research projects. So be able to speak maybe 10, 15 minutes about where you are in terms of thinking about your project and how you're gonna present the analysis, and we'll have some discussion back and forth. So we will start thinking about that. So Thursday will be more like a transition class. We'll still do some other, we have one more topic to talk about, which is data design. I'm trying to get a couple guest speakers to come in and talk to you. We'll see if that comes about. But well, thank you for staying around today and listening to Mr. Tellier. Mr. Tellier, appreciate you staying late. And I'll see you guys on Thursday. You guys have any questions for me?
This Maskaram, the power is off on their side.
Yeah, I understand. So so good job. I think you guys did a very good job with second presentations. Hope you appreciate the topics. I really think that you know, there's a lot of potential here. So you're seeing the potential, and hopefully we can try to exploit that when we talk on Thursday about which direction you guys are going to go with some of your research going forward. Okay. So thank you for the day, and I'll see you guys on Thursday.
Okay, thank you.
All right, thank you.
Okay.
Sorry, Professor.
Yeah,
That to mean that will come on Thursday with the idea of the research on which we are going to just conduct?
No, we'll probably do some other things. I'm still thinking about which direction to go. We'll probably do some other things also, but we're going to make that a priority because we want to start transitioning into, because already by Thursday, we'll be at the end of the third week. And by the fifth week, you have to do your presentations. So I at least want to make sure that you have some time to discuss with me at least 1 or 2 times so that you kind of making sure that you're going in the right direction.
Okay, with great excuse, can you send us with just with written instruction what we are going to do for just Thursday?
You talking about written instruction for your presentation or for what I'm going to do?
Okay. Okay. Thank you.
Okay. All right, we'll do it. All right, thank you.